welcome to the latest Retire Well episode with myself, Matthew, and I'm joined by Joe. And today we're going to cover tax efficiency of drawdown and potential strategies that people can use. This is a really common thing that we talk through with our clients because they're all about how much income they want to take and how they can do that in a tax efficient manner. So today that's what we're going to look at. My mantra is to not let the tax tail wag the investment dog. So when we talk through this episode, there's going to be things that we say is, this is how something's done in the most efficient way, but you should only do it if it actually aligns with your income goal or your capital goals. So what I'll do is I'll let Joe sort of jump in with what we tend to do to start with someone's pension goals.
Yeah, absolutely. I think a lot of this, like Matthew says, it is very much about how to maximise the tax efficiency, and it might not be right for everyone. What is the same for everyone is tax rates. So you'll have your personal allowance of 12,570, which is essentially your 0% tax rate before you pay anything. And then above that, you've got your 20% tax rate, which, to be honest, most people fall into in retirement. That goes up to around 50,000. And then anything above that is a 40% tax rate. So when we're looking at planning for retirement and drawing down on income, where possible, we want to pay the lowest level of tax, be that 0% under your personal allowance, or just trying to dip into the sort of 20% tax rate here and there. Matthew, do you want to sort of run through, I suppose, pre-retirement, or not pre-retirement, pre-state pension age, what's sort of the main thing that we look at with clients?
Yeah, I think, if someone was retiring today and they'd worked through the whole of the tax year, they would have used their personal allowance and they would have paid tax, that would all happen through the PAYE system. And we would say, okay, to that person, how much do you want to drop into your bank account per month? And to start with, the simplest thing to do would be to pay that from 100% tax-free cash. Under a full flexible drawdown, that's what you can do. You can see the whole of your pension, of which 25% of it is available to take tax-free. That could be one lump sum, but most commonly that can be taken as a monthly income alongside other income sources. What we would tend to do as a starting point with people is say, okay, what are your other assets? What's your expenditure plan going to look like? And decide that strategy, because often we have people who are retiring who might say, okay, well, I've built up cash buffers. So the first thing I'm going to do is draw down on cash up until the point then I'll touch my pension. And they could say, I always want to have 20 grand in cash or 10 grand in cash, whatever a magic number might be, and therefore they'll wait till their cash buffer drops to that level before they start with sort of pure drawdown.
Yeah, I think as well, as Matthew said, the tax is almost the secondary point. Before we actually look at advising on anyone that they're happy and able to retire at a certain date, we'll run through various different cash flow modelling scenarios, which is where we take your current assets, project them into the future, what level of income do you want to take, and then we'll essentially see if the fund will run out prior to your life expectancy or 100, and then that can allow us to look at various different scenarios of, can we retire today with a certain income? Do we have to wait a few years to retire on that income? Or could we maybe look at reducing our income or expenditure need now so that we can retire a little bit earlier?
Yeah, definitely. And I think when we go back to some of the episodes we did where we looked at annuities and drawdown, some of the scenarios were which one works best for someone, but equally it might be the question of, can someone afford to do it? And that's where cash flow modelling can be perfect. If we fast forward and someone is ready to retire and they've got an income need, so say it's £2,000 per month, what we tend to do is say, okay, we take 100% tax-free cash as we described up until the start of the new tax year. The new tax year then gives you the full personal allowance, and we can decide when and how to take the income. We've then got an open book where logically you would say, if you've got no other income sources, your 12,570, your personal allowance that Joe described, you would take 1/12 of that each month as taxable income, but paying no tax. And then anything above that to your income target, whether that's £2,000 a month, whether that's £3,000 a month, that could all come from tax-free cash. And therefore, in that tax year, in theory, you've not paid a penny's worth of tax. And any tax that you would have paid through a different strategy could be then still in the pot, still invested, to grow over time.
Yeah, I think that's a really sort of important point there. This is something that you can essentially take advantage of, that 0% tax rate, but pretty much only before state pension age. because when state pension age kicks in, currently the state pension is 11,500. Come April, I think it's got a 4.1% increase, so that's just under 12,000, which is pretty much almost all of your personal allowance. So you can only draw a very small amount tax-free before you actually start paying that 20% tax.
Yeah, definitely. And I think one thing we should say is when you think about full flexible drawdown, you can choose to take 100% tax-free cash, or you could take a mixture of both. What you can't do to start with is just take 100% of taxable income, because there's no mechanism for the tax-free cash to stay in a pension. So again, that's if someone was purely thinking on the tax efficiency and said, I don't need the income, but I want to use my personal allowance. We've had people say that in the past, and they've been almost confused when you say, okay, well, you're then going to have to use some of your tax-free cash to get to that point, which that sort of takes me to that, tax versus income and what's driving the decision. Some people go, I don't need the income, but I don't want to avoid using my personal allowance. In the past, we've seen people say, okay, well, what I'll do is I'll pay across my personal allowance plus some tax-free cash into an ISA if I don't need the income, because that way it's then fueling future flexibility of income, and that ties in nicely with an episode we're going to talk about wider products such as ISAs, investment bonds and general investment accounts. But again, it also comes down to that, what does someone want to do? Before you start talking about the nitty-gritty of income or nitty-gritty of the tax, what you want to do is, are you ready to retire? What income do you think you're going to need? What lump sum expenditure might you need in retirement? And it's that full financial picture that can then look at the tax side of things.
Yeah, I think like Matthew says, it's really about the sort of wider implications and what your goals and objectives are. One thing that's sort of changing in the next couple of years, where you might actually change your strategy with regards to pensions. Pensions, as we've talked previously, are at the moment very good for estate planning, because if you pass away before 75, you can pass that entirety on the pension onto your beneficiaries completely tax-free. There's potential changes coming into place, but generally prior to sort of 2027, the general advice with regards to pensions, if you're lucky enough to have cash assets or investments elsewhere, it can sometimes make sense to draw down on them before you access your pension, because the non-pension assets are assessable for inheritance tax at 40%, potentially if you're above your allowances, whereas the pension's completely tax-free. So that's one bit of change that we might see over the next couple of years.
Yeah, and I think essentially that's almost saying in the past and currently you would say there can be an argument for preserving your pension for an IHT efficient investment. That has been turned on its head, and it's more likely to be a spending tool. Again, going back to the traditional thing of saving into a pension for retirement saving and retirement income. And then it's just about the efficiency of how you do it. We've also had people ask questions of, they could see themselves being a higher rate taxpayer after state pension, for example, or with other defined benefit pensions to kick in at different points. So then they say, should I take more income in the early years and potentially pay tax just to try and then not have my income sitting on top of other taxable income in retirement, such as sort of state pension? Again, each person's scenario is very sort of bespoke to them, and you have to work around the right way to do it. My starting view is, if you can defer tax and therefore it's still in the pot and it's still growing, that has to be the most tax efficient way to do it. But if you see yourself having a large defined benefit pension plus your state pension, and you see yourself almost getting to that point, above £50,000 worth of taxable income where you are going to be paying tax at 40%, you then start to say, well, hang on, should I take some out and pay 20% tax early if there's something you're going to do with it? I think that can make sense. The other side of things, people can use things like the marriage allowance to benefit from 10% of a partner's personal allowance. Do you want to chat through those figures a bit?
Yeah, just before we move on to marriage allowance, I just wanted to sort of look at a point with regards to defined benefit pensions that you mentioned there, and potentially how they may interact with other pensions. So we are going to do a little bit more on defined benefit pensions in future episodes, on a little bit more of a deep dive with what your options are, how to take a scheme pension. One of the sort of key bits, if you're wanting to retire early from a defined benefit pension, is that you may be projected to get, let's say, £20,000 at your normal pension age, which might be 60. If you want to retire early and you're looking to retire at, say, 55, there's potential that you could get hit by an early retirement factor, which essentially penalises you for taking that pension early. Yeah. One thing which is good if you've got other pensions available is you might want to use those pensions to essentially bridge the gap between when you retire at age 55 to when you're able to access your normal pension age, your scheme pension, to essentially not reduce the amount that you're going to get over your lifetime in the scheme pension, while still almost filling the gap between retiring and getting that guaranteed income.
Yeah, good point. I think an early retirement penalty can essentially just, for some people it can seem like the penalty for splitting it out over a longer period of time. Mm-hmm. So you can say, okay, if you live to normal life expectancy, you're still going to get the same level of income, and it's just choosing when and how to take it. But bridging the gap is definitely sensible when it comes to cash accounts, pension flexibility. Most of our clients say they want to take more in the early years, so not just bridging the gap, but also taking extra in the early years from a flexible pension. You can take a higher withdrawal rate knowing that you've got guaranteed income sources to come in. So yeah, I think that's definitely a way to do it. And I think when we have people with a £400,000 pension, with £100,000 of that available to take tax-free, some people like the simplicity of saying, okay, well, I'm allocating that tax-free cash to between now and state pension age, so I'm drawing that between, say, 60 and 67, and again, they can see themselves, okay, that's the income that gives me, I'm not paying any tax, that's plan A. Again, the brilliant thing about pensions is there's plan B and there's plan C, where you can adjust things accordingly, but you've got a strategy and a cash flow model in place that lets someone sort of confidently make those decisions.
Yeah, absolutely. So as Matthew said, marriage allowance for married couples is, again, something that I don't think most people know about that can be quite beneficial. If one of you is a basic rate taxpayer, so earns between £12,500 and £50,000, or has that as pension income, and the other one earns less than that £12,500, the one that earns less can essentially gift it's £1,260 of their personal allowance to the higher earner, and essentially that means that higher earner is going to get 1,260 not taxed at 20%, because they're going to have an additional amount available at 0%. So that means if it's a full amount that's being gifted over to the higher earner, £262 can be saved per year in tax, which might not seem like a lot, but I suppose every little helps when it comes to that, and you can actually claim the previous 4 tax years as well on the marriage allowance.
Yeah, I think it's a neat little bit to squeeze your tax efficiency, and again, if someone can save around £250 worth of tax, it's a no-brainer, isn't it? So why wouldn't you do that? The same thing applies with pension contributions. We've often had a case where the husband and wife, one person could have the pension, and when it comes to a retirement strategy, we often get questions like, okay, is that a joint pension? So okay, pensions aren't joint. They're in individual names using individual allowance. So short of using the marriage allowance, there's no way to level that up. But you could save into a pension up until 75. You can put £2,880 into a pension, and the government will give you £720 worth of tax relief. That's 20% automatically added. So do that repeatedly over a few tax years, and you can quite quickly build up a pot in the person with less pensions, and they can then, in theory, draw that over a period of time, potentially all falling within their personal allowance with no tax to pay. So again, going back to your every little helps type phrase, hopefully Tesco's won't be listening, but again, it gives you that element of getting a bit more tax relief, drawing it on tax efficiently, and really squeezing the life out of the tax efficiency there.
Yeah, I agree. I mean, it's a sort of thing, in an ideal world, you'd have spoke to those clients 20 years ago when maybe one had 100,000 in the pension and the other one wasn't contributing, because then you can look at essentially reallocating funds while you're working. Because in an ideal world, you'd have 2 pensions that are worth almost exactly the same, 2 sets of personal allowances to use, and then you can be much more efficient. But as Matthew said there, it's really good to essentially, and you can do it for both partners, but it could make sense potentially if you've got one who's got a large pension and maybe a final salary pension with some tax-free cash.
Yeah.
You could look at adding the tax-free cash into the spouse's pension, which will allow them to then draw it out tax-free.
Yeah, I mean, I have had people joke about a tactical divorce for separating pensions. Again, technically it might work, the legal fees involved and the sort of moral side of things probably don't work. So it's better to do it the way we've described, to try and balance up pensions rather than having a technical divorce.
Yeah, absolutely. So I think another thing to sort of look at here, I suppose we're starting to look at almost mistake side of things, but one thing to be aware of is with regards to the money purchase annual allowance. Matthew, do you just want to run through what that means and potential implications going forward?
Yeah, definitely. There's plenty of jargon in our industry, and the money purchase annual allowance is definitely one of those phrases where it's sometimes on the bottom of a pension statement and someone goes, what the hell does that mean? In reality, what it means is you're reducing the amount that you can pay into a pension going forward because you've taken some taxable income from a flexible pension. So if you took tax-free cash as regular income, you're not triggering the money purchase annual allowance, and you can then, in theory, save into a pension up to £60,000 per tax year, as long as you've got that taxable income to match it. If you take a pound or a penny's worth of taxable income, you trigger that money purchase annual allowance, and that drops down from 60 to £10,000. Again, that feels quite restrictive for the majority of our clients. Because they're ready for retirement, because they've thought about it in the journey, actually people don't tend to worry about it because they're unlikely to save that much into a pension going forward. But I have had a few people in the past who, before they've spoken to us, they've accidentally done something and triggered it, whether it was cashing in a small pension, whether it was saying, I've got a pot there and I'm going to use that towards a mortgage. Again, I've seen that done, and people have accidentally restricted, put handcuffs on their pension contributions. And if someone does that from 55, but intends to work till 60 or 65, it can have awful consequences. I remember having a chat with a high earner who, I think they were earning about 150,000. They'd read or seen one of our videos about pension contributions and said, okay, it sounds really tax efficient. I'll put that into a pension. I'll adjust my salary down. I'll get my personal allowance back. All the sort of case study ticks of yes, yes, yes. It just happened in the conversations. Have you ever had any pensions before? I had a small one with Prudential. It was worth £11,000 at the time. It just felt sensible to cash that in and use it towards the mortgage. No one had told them they were triggering the money purchase annual allowance. It was just then written on one line in a statement they'd had, and therefore that £60,000 that they were talking about to adjust their income was restricted to 10, and there was a lot less flexibility they could do, and the tax they had to pay was what they had to pay.
Yeah, I think it's a pretty big advice point that most people aren't aware of. One, I suppose, of the workarounds of Matthew said there, it's a case where they took a small pension and they may have just took it all as taxable income and triggered, some as tax-free, some as taxable, and triggered the money purchase annual allowance. There is a scheme called the small pot scheme. Let's say if Matthew's client had 9,000 in the pension, instead of taking it in the normal way that you take your pension of just taking it all as tax-free and taxable, you can go through the small pots regime, which would not trigger the money purchase annual allowance. It would still let you take the pension in the same way, in the fact that 25% of it would be taxable, and 25% would be tax-free, I'll get that right, and 75% of it would be taxable, but it doesn't trigger the money purchase annual allowance, and you can do that for pots up to £10,000 3 times.
Yeah, definitely. And again, I think the real advice point there is don't do something with your pension that you're not 100% confident about. Mm-hmm. The individual who I spoke to was confident about it because they didn't see or feel about the rest of the sort of mechanism behind it. So again, people like ourselves to talk more about it, educate people and try and help people to realise there's a problem, and then you actively triggering the money purchase annual allowance when you first take taxable income as part of that retirement strategy.
Yeah, and I think, again, just generally with taking pensions or moving pensions, if a provider says you can't do this and you need to speak to a financial advisor, a lot of the time that means that it's got a valuable guarantee, and it might be the case that reviewing that actually might be the better option. It might have a minimum pension that it'll pay you, or might be entitled to a high amount of tax-free cash. And it's always just something that you could look at with a financial advisor and see if it's right for you.
Yeah, and crucially for people who are seeing that on a statement, some people get in touch and say, oh, I think I just need to sign a form. Again, it's not about signing a form, it's about advice, it's about what's in your best interest. Like you said, there's the potential for some really, really valuable benefits, whether it's a guaranteed annuity rate, whether it's a guaranteed growth rate, whether it's a guaranteed minimum pension, and you just want someone to really have a look over it and make sure it's in your best interest. One other thing on the tax side of things that people commonly say is, as I described, should I be paying tax while I'm drawing a pension to try and then reduce tax being paid at a higher point? The bit that I always come back to is, if someone passes away before 75 with a pension, there's no tax to pay for their beneficiaries. So if I was a beneficiary and I'd seen mum or dad draw down a pension and pay tax at 20% because they thought that was the right thing to do, and then suddenly I inherit the whole pot tax-free, again, one of my questions will be, well, why did they pay the tax then if they could have taken tax-free cash, or if they could have spent cash or done anything? So again, you don't know when and how you're going to die, so again, you can't factor that in practically, but you can also think, okay, every time I'm paying tax, is it intentional, or is there a strategy that a financial planner like ourselves can help work through? And I think that's the main thing when it comes to tax. People don't mind paying tax as long as it's not unnecessary tax and it's sort of thought through fully.
Yeah, and Matthew says there, sort of with regards to sort of paying taxable income or receiving taxable income, when we're looking at financial planning, we'll always look at sort of the overarching picture, and we'll run through a cash flow to try and work out when you might need capital expenditure. Are you going to be paying off a mortgage? Do you have plan any sort of large holidays that you want to go on? And the majority of the time there, we'll look at allocating some tax-free cash in the future for it, so that in 1 year, if you're looking at drawing 50,000 out of the pension for whatever reason, you're not going to jump up into the 40% tax bracket. So we'd look at doing that. If it's a case where all tax-free cash has been withdrawn and we are then essentially subject to tax on every withdrawal, then that's when you can look at maybe if you are looking at a tax-free cash a taxable withdrawal, from your pension, you could potentially look at drawing out that tactically over a couple of different tax years to benefit from a lesser tax rate.
Yeah, I recently had a inquiry from a client when he sort of said, okay, my circumstances have changed, I need to buy a new house. I need to take 70 grand, 80 grand today. Okay, you say, okay, well, you're already taking taxable income, you're already taking about £25,000 worth of income, plus you've already got your state pension and payments. So that whole taxable withdrawal for them one tax year takes them up above £100,000, start losing their personal allowance, it becomes really, really untax efficient. So the first thing you do from our point of view is you say, alarm bells, how do we avoid that? The logical thing to do is to say, okay, have you explored every other avenue? Have you thought about your cash balances? Have you looked at a mortgage? Again, people are starting to give mortgages for older people with things like pension income. But if that withdrawal does need to happen and does need to come from a pension, where we are today, we look at 2 tax years and we say, how do we sort of straddle both sides of it? So when we did the maths and said, let's take it, half in this tax year, half in the next tax year, they still get the capital required in this sense, just by middle of April, but they've paid a lot less tax by almost managing that. For us, that's what we do. For them, they sort of say, oh, brilliant, that's a great tax saving. That can help us not use as much of the pension for the house transaction.
Yeah, absolutely. So I suppose we've covered quite a lot of the sort of common mistakes and common questions that come in from a financial planning perspective. I think one that I come across every once in a while is a bit of confusion with regards to the 25% tax-free that you can take. Mm-hmm. It's very much about sort of the lifespan of your pension, that's the amount you can take through. It's not 25% tax-free. And I suppose that could also be another argument, Matthew, of not taking all the tax-free amount out at the very start, because then you can actually grow the amount that's going to be tax-free through investments, and you'll have a large amount tax-free in the future.
Yeah, I think one of the common questions is, I've entered retirement, I know 25% of this pot is tax-free. There's almost a human nature thing which says, okay, well, give me that, please, because then I've got it. Mm-hmm. We then say, okay, well, what for? If it's to do things like a new car, paying off a mortgage, if there's certain objectives, again, tick, tick, you can take that and do it. But actually, the most efficient thing to do is leave that invested and draw down upon that over a 20, 30 year period, a long and healthy retirement. And as you say, it goes up. Some people say, is it 25% of the figure I enter retirement with? Again, that wouldn't work because you've got a pot which is changing on a daily basis. So actually, it's as that grows, you've got 25% of anything which is uncrystallized, a bit of jargon, but essentially that you haven't touched or haven't used yet. So for a really efficient, drawdown strategy, you take what you need when you want it, but you then sort of draw that down, and the pot grows over time, and it can then grow quite nicely. The other thing we've not really talked about today is how you can use a pension and income in line with other sources of income. So, we're going to cover ISAs, general investment accounts, investment bonds in another episode, but really it's almost how you enter retirement with those different taps and how you can use them to get to your desired income plan, because ISAs are completely tax-free. Some people say, do I use my ISAs before my pension? Again, there's no hard or fast rule of that. It depends on what your other sources are, what your death benefit situation looks like, and when and how you might draw it. I had a couple of clients recently who had good levels of money in a pension and then had some ISAs invested, and once they'd used all the tax-free cash on their pension, logic would say, okay, we're now going to turn the ISAs on for regular income because that's almost the same rules. They had in their mind the ISA pots for things like gifts to kids, and things like upgrading the car. So in reality, for them, rather than taking the ISAs that weren't paying any tax, they actually said, well, we've got them allocated in our heads, so let's ignore them and we'll start drawing taxable income from the pension. Again, it's just working through what's the pots for, when are we going to use them, to work out what's the most efficient way of using them. And whilst the most efficient way then would have been to say, let's use the ISAs, actually the life plan, the long-term strategy was to use them for something else in the future.
Yeah, absolutely. And I suppose we'll just briefly touch on a common question that we had towards the autumn statement in October about the rumours that inevitably come round every time a budget or a spring statement comes up, and there was quite a few people that were worried that sort of tax-free cash was going to be taken away, and in the industry press there was many millions of pounds taken out of pensions. In the end, nothing happened to the tax-free lump sum. I think it's a case of if you've got a reason to take it out in the first place, so if you're paying off a mortgage or dues and vows, going on holiday, then it would make sense and you're doing it anyway. Taking it out for taking it out's sake, you're then taking it from a tax-free growth environment within a pension, and you could potentially be putting it straight into a taxable investment if you don't have any ISAs available. So I think that's one to touch on. Maybe don't be reactive with regards to stuff that isn't actually in place yet.
Yeah, I think we didn't have many clients get in touch about it because we have talked about the long-term plans with lots of people. I had a few people who were almost saying, okay, I'd be cheesed off if the rules change. If you imagine someone with over £1 million in a pension and they say, okay, I've got 268,000, whatever a magic number is, available to take tax-free. If that budget changed and suddenly that was reduced to 100,000 or suddenly disappeared, they would say, I'm going to be very unhappy. But in that conversation, like you described, okay, what will you do with it? What will you spend it on? Okay, well, I've got no plans to spend it. Well, where are you going to put it? I don't know. Are you going to put it in a bank account? Oh, I could do. Okay, you're then going to have interest. Are you going to be taxed on it? Again, okay, I don't like that. So basically, it all comes down to that long-term planning. The only time when we almost did react to the rumour was if someone was taking tax-free cash in the year and it was for certain scenarios, we could almost say, okay, let's bring that forward. We know you're going to take it in this tax year. If that's your regular income, let's pay it as up front now. Let's turn off the income tap and we'll wait till the next tax year to put it back on. That worked for some people where you just have the certainty of it. But yeah, in the industry press, there was lots of people who'd taken it. I mean, I saw someone who had a financial advisor who suggested people take it and then use the cancellation rights within 15 days or 30 days to say, put it back in. We then had pension providers and say, well, that's actually not how cancellation rights are designed to work. So you actually had some people who were then being told, no, you can't put it back in. So some people had almost tried to be too clever. So I would always sort of, be on the side of caution with that to say, don't try and don't try and manipulate and manage it, because again, what if the market moved and then you come out of the market to put it back in at a lower rate? So yeah, I think you can't second guess what the government are going to do. You can't second guess changes to tax rates. For us as financial advisors, we have to digest the information and then present it going forward, and that's probably the best thing we can do.
Yeah, and I think we've got a plan to look at the sort of the spring statement at the end of March, see if there is anything that affects clients and potential clients, and we'll probably talk through that in a podcast about what it means for you and what you could potentially do going forward.
Yeah, I think currently most people are worried that the Labour Party's current mantra is to tax more, to try and almost fill that black hole. And they almost think, okay, where's that going to come from? People have said then ISA allowances and other things might be reduced. Again, we just have to see what happens with that. But in general, when clients are worried about it, what we tend to say is, any big changes to pensions, whether that's tax-free cash, whether it's to state pension, anything like that, it's going to be quite unpopular for voters. And bear in mind, everyone's got a pension and everyone's entitled to a state pension. Do you really want to be the politician that's known for scrapping tax-free cash? I always say, Margaret Thatcher, the milk snatcher, who's going to be someone who has a bad connotation with changing pensions? So personally, I can't see it happen dramatically, but we have to work through anything that comes out of it and build plans accordingly.
Yeah, absolutely. So I suppose just wrapping up the key points before we end today, we've done the typical financial advisor thing of how do you draw from your pension tax efficiently. We've said it depends, but it really does. We've run through a few different things that you can think about with regards to drawing your pension there, but it very much does come down to your individual circumstances. But hopefully we've had a look at a couple of free wins that you can get there about sort of trying to draw on a more tax efficient basis.
Yeah, can I just throw in one more on the death benefits? And it's one we've talked about previously, but the more we talk about it, the more it can sort of stick for people. And that can be the nomination.
Yeah.
Again, if someone passes away before 75 and they've nominated their spouse who might be a similar age, but also children, those children have the ability to take that tax-free. If we imagine it goes from husband to wife, and then the wife carries on and lives beyond 75 and lives to normal life expectancy, those death benefits would then be left to the children and they'd be taxed at the marginal rate. So if we're thinking about pure tax efficiency here, nominating the children with a couple of percent and having that family committee meeting on first death could reallocate some funds that could be used tax efficiently. So that again is a really important tax planning opportunity. I still say don't let the tax tail wag the investment dog. So you still have to say, the death benefits might be needed by that surviving spouse, in which case that's 100% the right way for it to go. But if someone says, oh, well, I can never see myself spending that money and it's going to go to the next generation, a bit like a legal deed of variation, adjusting those pension death benefit allocation can be really, really important.
Yeah, absolutely. So thank you very much for watching. Next week, as Matthew says, we're going to run through a lot of non-pension assets that can help you with your retirement. If you've got any questions with regards to drawdown, pensions, or anything else financial advice related, feel free to put it in the comments. Like and subscribe as always, and thank you very much for watching.